And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani. It is a record year for ETFs, nearly $1 trillion in inflows so far, and over $10 trillion in assets under management. What's next in 2025? Let's talk with Jay Jacobs, U.S. Head of Thematics and Active Equity ETFs at BlackRock, and with financial futurist and my old pal, ETF expert Dave Noddick. Jay, one big theme you had for ETFs in 2025, acceleration of the AI infrastructure phase that we're in. I know that sounds fancy, folks, but we're now entering an additional phase where AI is going to be much more integrated into consumer and enterprise applications, and eventually new business models are going to emerge. Tell us all about that and what ETFs might be applicable here.
Sure. Well, it's still very early in the AI adoption cycle. We've seen hundreds of billions of dollars invested in AI by some of these Mag 7 mega cap tech names, but adoption still will take time. For me to use it in my everyday, you and Dave, it takes time for people to change their habits. So the stage that we're in today is this $250 billion annual investment from mega cap tech stocks to build out data centers, to buy the latest chips, to train their models with bigger and bigger data sets. And all of that is really leading up to making AI more and more powerful to the point where we can't ignore it anymore. We have to use it in our everyday lives because it's such a powerful tool.
And of course, there's ETFs for that.
So this
BlackRock has them. What a surprise. Oh my.
So the way we have to think about this is from the entire value chain perspective, that it's not just about mega cap tech names. There's other semiconductor companies, there's other data center companies, there's other software companies that are benefiting from the rise of this theme. That's where we see funds like ARTI, which is an index-based artificial intelligence
ARTY.
ARTY, or BAI, where we have a portfolio manager picking individual stocks for who could be the winners in AI going forward.
So one's active, one's index-based.
Exactly, yeah.
Now, as the whole mega force, I don't know what you call it, for AI evolves, investments in cybersecurity can become more important. I know this is one of your themes that you've been talking about. Tell us about that and what ETFs we've got for that.
So if you think about what AI is doing, it's taking data and making it more valuable because we can interact with it, we can learn from it, we create new things based off of that data. As data gets more valuable, companies that own that data or people that own that data are going to spend more money to protect it. So just like if you had a more expensive house, you'd buy more insurance. If you think about your data, you want to spend more on cybersecurity as it gets more valuable. And so we think this is really going to benefit the cybersecurity, software community, which is seeing very rapid revenue growth based off of this AI.
And of course, cleverly, iHack is there. And just show us, there we go, thank you. There's your largest holdings, SentinelOne, Fortinet. Any theme here about how you're picking the selections here?
A lot of it is about the larger getting larger. The big cybersecurity names tend to benefit from their own bigger data, their own bigger client bases. They are at the leading edge of how cybersecurity is defending data, and so they tend to get more and more clients going forward and grow their top line revenue.
Dave, your thoughts on all this? How is AI going to shape ETF investing?
I feel like there's another shoe to drop on this. So sure, we're going to have this middle area where we can see the build out in the AI companies themselves, in the software companies themselves. I think it's really interesting to think about the tails of that industry, which I would call infrastructure, things down to power, water. We're seeing huge inputs into the power sector. Real innovation happening there. These companies now making major allocations for their own generation capability. I think that's a trend we're going to see much more of going forward because it's only going to get hungrier. Yeah. And then on the other end, those companies that take the work those AI companies are doing and really bring them to retail. You said it's going to take some time before this is part of your day-to-day life. When it's on your phone and you're talking to it all day, that's when it's going to matter. So I would really look towards those retail names that we're used to thinking about, say an Apple or even a Samsung, folks that are making those devices. When you see the integration really work there, that's something to pay attention to.
Your thoughts on that? I mean, Apple's such an obvious choice here from a beneficiary point of view. I have the new iPhone, and they're already telling me about, how I can integrate my email, and they'll summarize every single word on the emails for me on AI and infrastructure.
I couldn't agree more with Dave on the infrastructure side of things. If you look at the last 15 years in the United States, you had zero electricity demand growth. You had population growth, you had economic growth, but we didn't need more electricity because we were actually getting more efficient with electricity.
And we weren't getting a lot of household formations, too.
Right.
That's
Not
another
a lot
thing.
of household formation. All of a sudden, because of AI, because of electric vehicles, because of a growth in manufacturing again in the United States, you have a lot more electricity demand, and that if you think about a utility going from 0 growth to 2% growth, that's actually a complete shift in how they have to think about their capital expenditure planning, where they're going to get funding.
Yeah. Who would have thought utilities would be an AI play? And yet that's what happened this year. It's really, it's not just, we can't say they're just interest rate sensitive plays, they're AI plays.
I think what people forget is kind of magical as technology is, there's real physical things on the ground that run that technology. Whether it's power, whether it's data centers and real estate, whether it's chips, it's not just something that lives in the ether, in the cloud. There's real physical things that have to happen. And that means energy, that means more materials like copper, that means more real estate. You really have to think about kind of the physical infrastructure that underlies it.
Yeah, I want to just move on here. You've also jumped into the mega cap exposure business here. You've launched an ETF that holds the top 20 ETFs, top 20 stocks in the S&P 500. You launched another one, the top 30 NASDAQ 100. So NASDAQ 100 is not enough. Now we have the NASDAQ 30 that you launched. I know mega cap tech concentration has paid off. But why do you think the public is going to keep pouring more and more money into the biggest companies? What's the? I mean, it seems like this is a late play to me, but maybe I'm wrong. What is your thing?
There's kind of two different things happening. One is if you look at the end investor space, a lot of people in the United States still just don't have stock exposure. They don't know where to start. And I think if you can bring out a fund that gives them exposure to names they know, that they understand, maybe they interact with in their everyday lives, that's going to give them comfort to step into the markets as a stepping stone into ultimately building a broader portfolio. So in some ways, it's an on-ramp to ETF investing. The other angle is looking at professional investors who frankly over-diversified and have missed out on a lot of this Mag 7 rally because they have so many other exposures beyond it. They want a precision tool to dial up and down their mega cap exposure, and this is a very efficient tool for them to do.
But is mega cap really an asset class? Like tech is an asset class. Mega cap tech dominates it, but is Lilly and Berkshire, is it an asset class?
So it is in the sense that they do tend to have performance characteristics as a group. And so for that reason, I'm with you on that you need a really sharp tool if you're an allocator at an institution and you want to fine tune that mega cap exposure up or down, long or short, totally with you. I'm not sure I buy the on-ramp to ETF investing just because we're talking about a very under-diversified portfolio. And the math would suggest going back hundreds of years, something like 25 to 30 stocks is the minimum requirement for a diversified portfolio, but that assumes that you're agnostic across industry. Yeah. You can't say that about the Mag 20 or the Mag 30 here.
Because it's so hyper-concentrated in tech.
They're very hyper-concentrated in tech.
Yeah. So is the average investor too concentrated? I mean, this is sort of a broad intellectual question. But
if you read things like the subreddit for ETFs, you will find people absolutely want to get very concentrated because they're really speculating. They're not thinking about their 10-year time horizon, they're thinking about their 2-month time horizon. And absolutely, these kinds of products are great for making those kind of speculative bets. I'm reluctant to tell a lot of people their initial 401k effort or their initial IRAs should be into something that's 20 stocks versus say 500 or ITOT and buy the market.
Well, for sure, they're giving people, BlackRock's giving people what they want. I mean, the flows have still been great.
Of course.
It's not like everybody's like abandoning big cap.
And if I could comment on that for a second, what you've seen is 20 years ago, the entire U.S. equity markets were about $15 trillion. Now that's the top 8 companies alone. And what you see is a lot of these top 8 companies are web services companies, they're also consumer discretionary companies, they're cell phone companies, they're also services companies. When you buy into this top 20, you're actually getting a really wide range of companies and services. They also have their own corporate development arms that are investing in a lot of smaller companies. You're getting diversification in these top names. What it's helping is a lot of investors who are either not invested, or if they are investing, they're picking one of these names, and it moves them into a much better portfolio.
The basic idea is the big are getting bigger and continue to get bigger, except historically it's been hard to stay in that top 20 and top 30.
So math would tell us that if you've had a really great run at the top of the index, you're headed for pain. That's just how that's worked over time. I do think it's worth thinking that it might be different this time. We're in a very different regulatory regime. We're in a very different political regime. Corporate power is more relevant than it's ever been up and down the regulatory food chain. So betting against mega caps, I think, is a tough thing to do. I'm not sure going even more into mega caps is the right call.
It's a different world, isn't it, than 20 or 30 years ago? I mean, it's an asset-light business now. These companies, it's software that they own and intellectual property like Lilly has. It's not, giant industrial, pieces of machinery and things like that. The whole nature. This is why I think like it's possible for the S&P to have a higher PE ratio, 22, whatever it is going forward now, than it was, 20 years ago. Maybe it was 15 was the average. Maybe we can have a higher PE ratio if you have an asset-light series of big companies now whose primary ownership is software and intellectual property and not machinery, for example. So,
well, I think that's been true since the dot-com boom, right? That's when we first saw intangible value being what drove PE, and now we've got, MicroStrategy at a 2,000 PE. So there's no question that innovation tends to drag that PE higher.
Okay, so let me move on. We've had a couple of themes here. AI, talking about top 20. How about infrastructure investment? This is one of your themes. BlackRock's had it as a theme for 2025. The Infrastructure Investment and Jobs Act, remember that one? In 2021, that was the largest infrastructure investment project in U.S. history. $1.2 trillion to build and repair bridges, airports, waterways, public transit. Tell us about, I know this is one of your themes, you have ETFs for that. Do you think that's going to continue? It seems so, because most of the money hasn't been spent yet in this
That's a big
bill.
part of it. So the bill passed in 2021, but you think about they have to identify the infrastructure projects, do some design work, do some environmental work, and then you get the green light to start putting shovels in the ground. That can take years. When the shovels are in the ground, that's when a lot of the money is being spent. So we're starting to see a lot of these projects really start to enter that construction phase where a lot of dollars are going to be spent building new infrastructure, repairing existing infrastructure. What I would say, though, is a lot of people want to kind of tie this to election results. Infrastructure is one of the areas that has some of the most political consensus. And this is important because infrastructure is not just about the president or at the federal level. This happens at the local level, this happens at the state level, and it happens at the federal level. And it happens with public-private partnerships where you have private companies involved too. So you really need a lot of consensus up and down the government and with corporations to support infrastructure.
That's a good point. I mean, nobody's going to argue to repeal the Infrastructure and Jobs Act,
well,
right? I don't think there's going to be a lot of support to do that.
They will for political points, but they'll just rebrand it and we'll do the same thing. So I'm with you. I think that we're going to continue to see this kind of investment. It's not really an option. We all know how desperately needed. I mean, it was a joke for years. It was Infrastructure Week for 12 years or something, right? So we know we need the investment. We've got the pathways now to get those picks in the ground. I think the money will be spent. I think it's a great place to look for a little bit of a targeted thematic investment.
Now, explain the differences here. We're putting up, if you could put back that full screen of the three ETFs. We obviously asked for investments here. Can you make the distinction here of what's going on? Are these active or passive, index-based? And what are you owning? Just very briefly with each.
Yeah, so these are all index-based ETFs, and they're touching on different parts of the physical economy. So you have infrastructure, where you're building new roads and highways and airports. You have manufacturing, which is building more factories that can build goods in the United States. Think about we're building some fabs to build semiconductors in the U.S.
And that's made, here it is.
That's made, and then finally you have ITB, which is the home construction. You have a huge demographic tailwind with the rise of millennials and them earning their peak earnings years that want to buy homes. 86% of renters say they would like to own a home but can't afford it. So you have a lot of just construction happening around the country right now, whether it's infrastructure, factories, or houses.
Okay, so we've talked about AI, we've talked about cybersecurity, we talked about mega cap exposure, we talked about infrastructure. Let me move on here. I haven't talked about Bitcoin yet. We're 15 minutes into the show. I haven't mentioned Bitcoin yet. We're coming up, you know this, right? The 1-year anniversary of the Bitcoin ETF launch, that's in January. We'll talk about it in January. But I just want to mention iShares Bitcoin ETF, that's IBIT, I-B-I-T, is the market leader. It's amazing. We have $100 billion in Bitcoin ETFs. You have half of them, I think $48 billion. That's really quite impressive since launching. This is one of the most successful ETF launches of all time, generically, Bitcoin ETFs. Dave can talk about this. But what is going to be the main driver of Bitcoin in 2025? You don't have to be bullish or bearish, just tell me what you think is going to drive it.
I think there's a few different factors. One is what happens in the interest rate world, because we saw rates start getting cut this year. If you look at a lot of professional investors that are looking at Bitcoin as an asset class to include alongside stocks and bonds, they look at it relative to what's the income I get from Bitcoin versus something like treasuries, very different asset. As rates come down, Bitcoin can become more attractive, just like gold. What's also going to change, though, is kind of expectations around the main fundamental drivers of Bitcoin, which is what is the inflationary environment around the world and what is the kind of geopolitical risk index around the world looking like as well. If we enter a period where inflation is stickier or there's more fragmentation around the world, that could drive more fundamental belief in Bitcoin as well.
I don't want to get into too philosophical discussion on Bitcoin, but Dave, do you think Bitcoin is meeting what was the original use case as a global monetary alternative? That's sort of, has it really met that use case? I'm sorry to be, ask an obvious question.
I think it's met the digital gold use case, and that people are using it as a digital store of value. It's not being used as a transactional system. We all know that. There are solutions for that. The level 2 solutions work. They're viable. What we've seen, though, is the institutionalization of Bitcoin as its own asset that is unique and disparate from crypto. So Bitcoin by itself is not Ethereum and Solana or any of these other things. Bitcoin is unique. As such, I think what we're going to see in 2025 is the dynamic of Bitcoin, what it's worth, how it's trading, how volatile it is going to actually start being driven by exchange-traded products and less by on-chain people trading crypto. We've already seen that. The volumes in IBIT are phenomenal. I mean, I don't know what they are off the top of my head, but I would not be surprised if there are days in which the complex of Bitcoin ETFs trades more notional than trades on-chain directly. The volumes are insane, and
really?
Because of that, you have to expect more price discovery is going to move.
You're talking about the volumes now, not assets under management.
I'm talking about the volumes, just the amount trading. With the options running, I mean, I'd love to hear your thoughts on that. With the options on IBIT now trading, that cracks open the asset class to all sorts of investment strategies that were basically impossible.
Has volumes
before.
increased? By the way, folks, in case you don't know, options on IBIT were trading just recently, what, 2 weeks ago?
A couple weeks ago.
Yeah, and they were very successful.
Yeah.
Has that led, does options trading generally lead to more trading of the underlying?
Absolutely, because people need to hedge out that delta. They need to hedge out the underlying security, right? The options dealers don't want to be long or short anything, so they're always going to be using the underlying as a way to get out or into those positions. IBIT's already extraordinarily liquid. They don't need to go to another asset class. They don't need to go on chain to get that exposure.
What have you seen with your trading in IBIT since the options? This was 2 weeks ago, the options on IBIT, the Bitcoin, their Bitcoin.
We've had a tremendous amount of volume. I think part of it is a lot of people can really customize their risk, their income, their upside potential with these options. So if you think about people who maybe have made a lot of money in Bitcoin, they want to maybe protect some of those gains. People who are holding a lot of Bitcoin and not drawing any income from it, maybe they want to sell covered calls on top of that to generate some income with that Bitcoin. So it just expands the ways that people can own this asset and have it play a role in their portfolio, which gives people a lot more customization and a lot more kind of ability to hold it in a portfolio.
But have you seen more, I mean, it seems like you would have seen more volume since the options came in, but it also corresponds with the election too. It gets a little complicated doing a cause and effect here. But the short answer is yes, we've seen more volume. I'm asking.
We've seen volume. We've seen volumes increase. We've seen inflows increase. But you're right. There's multiple factors at play here. Whether it's the volatility in the price, whether it's the regulatory environment, whether it's the options. All of these things have kind of coincided.
And not to be cynical or weird, but how did you get half the volume? We got $100 billion in assets under management in Bitcoin ETFs. That's a lot. That's a very successful launch. I don't know if it's the most successful in history, but BlackRock has, I think, 48 billion, half of that. There's 8 or 9 Bitcoin ETFs out there. I mean, and they're all essentially the same product. You're owning Bitcoin. I mean, go ahead and tout yourself a little bit. How did you get half the product?
We see consistency across all different client types that they are looking for quality behind this product. They want to go with a brand that they trust is going to deliver the price returns of Bitcoin. And being able to invest in a BlackRock product by trading in an exchange, holding it in your brokerage account next to your stocks and bonds, just makes quality very accessible with IBIT.
It reminds me of Schwab. Remember when Schwab entered the ETF business? They had these plain vanilla nothing ETFs, and everybody said, nobody's going to, there's nothing new here. And yet they powered themselves right in because they had the pipelines, the distribution network for people to instantly pick it up. Is that a factor here?
I think
I'm trying to figure out why.
Brand really matters. I think brand matters even more when you're in a new asset class or a new area of doing something. Whether you love or hate BlackRock, one thing you can say from this, they tend to stick by their products. They don't shut down half their product line every week or two. They're willing to put a product on the menu and say, no, we're committed to this. This is how investors should think about an asset class. I think that's part of the reason for it, is the brand for iShares is, you're the ETF, folks. You've been there from the beginning. I think that's hard to compete against.
Okay, we're going to have to leave it there, folks. The one-year anniversary of the Bitcoin ETFs coming up in the middle of January. We'll be there. We'll talk about that and see what else we can bring you for 2025. It's been an absolutely amazing year. We got more ETF Edge coming up, but this is a one for the record books, folks. And we'll talk more about that on the show coming up, our podcast. So I'm going to have to leave it here. That does it for this week's ETF Edge. My thanks to Jay and Dave. We have asked Dave to stick around, give us a little bit more perspective on this record year for ETFs. That's the ETF Edge podcast coming up. And remember, all of our shows are on our website. Starts going into our 7th year, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.